Fund Supermart, your online gateway to unit trusts.
Today we have Matthew Eagan, Vice President and Portfolio Manager of Loomis Sayles and Company, to talk to us about the Multisector Income Fund. Hi, Matthew.
Hi.
So, Matthew, the Loomis Sayles Multisector Income Fund is positioned as a flexible, go-anywhere multi-sector portfolio. So tell us, which fixed income segments do you see the most value in right now?
Well, we're positioned long credit and a bit long in the non-US dollar space, so some global exposure. Where we have very little exposure is in the rate segment. So in term structure risk, we don't think we're getting paid in the developed world where rates are really low, and we feel that the risks are skewed to the downside for investors. So if you look at our duration and our interest rate sensitivity, it's quite low, even for our standards, which historically we've varied that over time. So it's not that we're strategically underweight all the time, it's just that's our view right now. In the corporate space, we just recently came off a growth scare. Investors were very nervous about global growth prospects, and we've seen a trade-off in some of the global currencies and in the credit markets. I think high yield looks particularly attractive, and I think some of the commodity currencies also look attractive because they're pricing in really a hard landing in China, and we think that's a little bit extreme.
What are your thoughts on the impending US interest rate hike, and what are the implications for the fund?
Well, the implications for the fund are really, there aren't any really big implications for the fund because the fund is actually designed to have a very low correlation to treasury returns. So our correlations are low to term structure risk. We're not taking a lot there. So we shouldn't be fully affected by what's going on with the Fed. We do expect the Fed to start to normalize interest rates sooner rather than later, but it's, December looks like now is priced in for a potential rate hike. There's about a 75% chance, and we think that makes a lot of sense. The Fed has indicated that they're likely to act, and I think the conditions are there. But that's really priced into the market. And I think what's more important is what is the pace of rate hikes thereafter. And I think going forward, we'll likely see a very unusually gradual pace of adjustment that'll last for a while. So we'll have a protracted cycle. This recovery has been protracted already, which reflects the protracted and shallow recovery that we've had globally. So I think that we could see more volatility in the markets because of the uncertainties accompanying Fed policy, hikes. But I think a lot of it is already priced in, and some of that volatility we've already experienced, but it's priced in now. And I think valuations, particularly in risky assets, look more attractive.
The fund has the flexibility to invest in equities. So is equity exposure a significant part of the overall strategy?
Well, it's part of it. It's not a significant part of the fund. I mean, we are a fixed income fund at its heart. But on the margin, we can add equity risk exposure. It comes in two flavors. We have a small portion that we can invest in, about 5% to 10% directly in common stocks. And what's unusual about this period in time is that dividends that are paid on common stock, the dividend yield on common stocks, is very competitive with the yields that you can get in the bond world. So there are certain companies there that we've started buying that the dividend yield on the company stock is often at least as good or better than the long-dated corporate bonds that same company issues. So we think it's reflective of the low rate environment. We think we can add value by buying securities. We can look up and down the capital structure and look for the best opportunity, whether it's in the debt side or the equity side. But again, that's a very small allocation and not a main driver of performance. The other area where equities can come into play is in the convertible bonds. So convertible bonds, some of them trade with the option, or they all have the option to convert into stock. In some cases, they're busted, meaning that the option is trading at its floor price and has very low sensitivity to interest rates. So those are more like fixed income instruments. In other cases, the stock will rise to a level that it gets closer to the strike price, and it'll have much more interest rate, more common stock, sensitivity to the common stock. And in those cases, we can look for opportunities that where the stock has some lift, you get yield from the bond side of it, you have a floor provided, downside protection provided by the floor price of the bond, but you get the upside from the potential increase in the stock prices. So we've actually had we've had corporate bonds that are convertible that have actually converted into stock, and that gets included in our equity positions as well.
So what do you think is the biggest risk for investors in this fund?
Well, we're positioned for a reflation, and if you look at our main positions in the corporate bond space, high yield bonds, some of our commodity-based currencies, you have to expect there to be some improvement in economic conditions and in the commodity complex, and we think that makes a lot of sense. We think we just left a growth scare. The U.S. is growing quite nicely. The underlying growth is about 3%. And we think China is getting its legs, and it will start to grow on a more stable footing starting next year. And the commodity complex is already priced at very low levels. It's priced like, again, a China hard landing, and we think that's too extreme. So we think we could see a bounce there. And particularly in parts of the commodity space like oil. Oil looks like it could rebalance by 2017, and we expect oil prices to be a lot higher than they are today by then.
So what is your outlook for the various fixed income sectors over the next 2 to 3 years?
So I think over the next 2 to 3 years, it's always hard to predict exactly how things will play out, but I expect the Fed to continue to gradually raise rates. So the short end of the Treasury market will start to rise, the yields will start to lift up, the curve will flatten out like it normally does, and ultimately we'll see the Fed funds rate move to maybe a 2% area, maybe 2 to 3% at the end of the Fed cycle, which will take about 3 years or so before the first rate cycle ends of this rising rate environment. And then I think the long end will be very flat to the front end. So it'll be very challenging for, say, the 10-year Treasury rate to get much above 3 or 4%. That'll be the end of the first phase of this rate hike cycle that we think will go on for some time thereafter. But this is the end of the first cycle. And I think the credit markets will bump along and do well. You earn your coupon, you get that extra carry, and it absorbs some of the rate rises. As treasuries rise from below, spreads will tighten in the corporate space. And I think over that period of time, we might see some recovery in the commodity sectors and in the commodity currencies, as well as certain emerging market countries. But that'll be the end of the cycle, and the credit cycle will start to turn at some point. Probably in that time frame, you could start to see the U.S. economy roll over.
All right, thank you for being here today with us, Matthew.